Hi, it's Michael Farr at Farr, Miller and Washington. Thanks for joining me again this week. We have some news from the Federal Reserve today. The minutes of the January meeting were released, and it showed those minutes showed that the Fed was reluctant to remove the word patient from their statement, that they still think that rates are unusually low and that they should probably be there for a while given some deteriorating financial conditions, economic conditions in Europe and other places around the world. I've mentioned to you before that at my speech at the University of Delaware with Fed President James Bullard from St. Louis, he really wants that word patience removed. He thinks that that will really give them the latitude to raise rates. He believes that these 0% or near zero interest rates that the Fed has in place now are emergency condition rates, that we are in more normal economic conditions right now, and therefore that near zero rate is not appropriate. He's probably right. He thinks that the Fed should raise rates at least to plant that stake in the ground, perhaps a quarter to a half a point, and then go sideways and then become data dependent. So he's not really saying so much that the data are so strong, but rather the zero rate level is just so weak that it should be raised and that the economy can take that sort of a move now. We'll see when the Fed gets around to it. The minutes also showed that the inflation data were weaker than expected, that we really are much closer to that 1% level of inflation rather than the Fed's 2% level. Janet Yellen has said that she wants to be closer to that 2% level before the Fed actually raises or tightens policy. We will see. In our market commentary that goes out by email, we discussed the rally from being down 10% to only being down 2% in bank stocks. Lots of people are growing more optimistic about the prospects for banks in a rising rate environment. Doesn't make a lot of sense to me. I discussed that there. So the Fed is still struggling with the time frame to adjust their information and also, when they can actually go ahead and raise rates. They continue to be hawkish. We'll see. We think it's going to be important. We think that this is a time for caution. This is not a time to be overly aggressive. And just so you know, market's reaction. Market was down about 50 points. It rallied about 50 points, almost to the opening levels at around 18,040, 45, and right back down to 18,000. Bonds rallied. Bonds rallied significantly. Yield was at 214. We're now down at a 206. That's an increase of 22/30 seconds in price on the 10-year Treasury. So there's still a lot of caution out there. It seems like the Fed will be with us for a little while longer. We're all going to look very closely at the March meeting coming up. Don't underestimate the Fed, and don't underestimate the hawks' determination to raise something this year. Be cautious. If you remember the rules to buy low and sell high, Dow 18,000 is not low. So if you need a little help, give us a call at Farr, Miller in Washington, D.C. I'm Michael Farr. Oh, and I'm on Nightly Business Report tonight if you want to catch up. Thanks.